Do you know what is GST and GDP? Well, let's see. GST, or Goods and Services Tax. GST is a tax that is added to the price of goods and services when you buy them. Instead of multiple different taxes, GST combines them into one system to make things simpler. How it works? When you buy something like clothes, electronics, or foods, a percentage of the prices goes to the government as GST. And why it exists? Well, before GST, there were many complicated taxes at different stages like sales tax, service tax, and VAT. GST replaced them with one unified tax system, making it easier for businesses and consumers. Well, now who pays this GST? Businesses collect GST from customers and then pay it to the government. Types of GST. CGST, or Central GST, goes to the central government. SGST, or State GST, goes to the state government. And IGST, or Integrated GST, used for goods traded between states. Now, let's see GDP, or Gross Domestic Product. GDP is the total value of the all goods and services produced in a country certain period, usually in a year. Think of it as a measure of how much a country produces and how strong its economy is. How it's calculated. If a country makes cars, foods, houses, and provides services like banking and tourism, all of these add up to its GDP. Why it's important? Well, a high GDP means the country's economy is strong and growing, while a low GDP could mean the economy is struggling. Let's see the types of GDP. Nominal GDP, the total value of goods and services at current prices. Real GDP, adjusted for inflation to show actual growth. Per capita GDP, GDP divided by the population to see how much each person contributes on average. In short, GST is a tax you pay on purchases, and GDP is the measure of a country's economic strength.